Hi, I'm excited to launch the Retail Bond Index by INRBonds. I'm Arjun Patsarthi. And just to give you a brief introduction of INRBonds, INRBonds is a online bond platform provider regulated by SEBI. And we are in the business of enabling retail investors to get access to the bond markets and through a highly technology driven and transparent process, giving the best prices, information, and the best of investment options to the investors and financial advisors alike. And one of the primary objectives of INRBonds is transparency. And the best way of giving transparency to investors is through an index. As every investor knows in a country and in the world, that indexes, now if you take a Nifty or a BSE, Sensex or a NASDAQ or a Dow, everybody knows what levels they are. So they give a general trend of where the markets are headed, where the prices are headed, and a lot of information is provided on the index. And in India, in the bond space, a lot of indices are towards institutional investors because they have been the largest investors in the market. And most of the institutional investors invest in the highest rated bonds, which is AAA or government bonds and others. And there are enough information provided on those PSU bonds like Bharat Bond ETF, which is an index of PSU bonds, or AAA indices which are launched by NSE and CRISIL and others. However, for the retail investors who are now coming more and more into corporate bonds, given that they have seen the value of corporate bonds in their fixed income portfolios. Now, with the options available, there are various maturities, there are various yields available, and most of them are looking for options that can beat inflation, which is their biggest bugbear. But how do they know what price are they getting? What yields are they buying? Bonds. And they don't have an index to refer to. And most of the investments are in the below AAA category, where the yields are higher, obviously. And those are returns that beat inflation, but they should also be well aware of the risks that they are investing in. Hence, given all these considerations in mind, and the fact that there is a genuine need for a retail corporate bond index, we took the trouble and also used our full capabilities of technology, data analytics, and the fact that our understanding of the retail corporate bond market to bring out an index. And in this bringing out an index, we actually work with a youngster from the Symbiosis School of Economics, Jayavardhan. One of the key policies of INRBonds is to encourage the younger set of students, graduating students or postgraduate students, interested in finance, interested in technology, interested in data analytics, and interested in the various latest computing tools of AI, ML, and many others that are cropping up. And INRBonds is aiming to be a key player in all these segments, given that these are going to be key driving features of platforms in the corporate bond market and bond markets itself going forward. INRBonds as a platform now enables investors to invest not only in corporate bonds, in government bonds, state development loans, in treasury bills, in commercial papers, in CD, certificate of deposits, and many others coming up. So this index is largely based on the fact that we call it the INRBonds Retail High Yield Bond Index. And high yield does not necessarily mean that it is a junk bond or it is a index which is only showing bonds that are highly risky. There are many bonds that are giving very reasonable returns, but with a very moderate level of risk if the analysis is correct. An index like INRBonds high yield bond in retail high yield bond index is a very clear reference rate for investors to invest in corporate bonds invest in corporate bonds that are very stable in nature in terms of the fundamentals, and have been providing consistent returns over a period of time. And also many of the constituents of the index, some of them are new to the corporate bond market space, but have found a lot of favor with retail investors, given that their equity price, they have a lot of information available because many of them are listed in the equity markets or other kind of information available. And many investors are very comfortable with the names. So all these put together, we have created a diversified set of bonds in an 8 bond index. We have kept it a 3-year constant maturity index. So the index will always remain 3 years. So giving a very strong reference rate point for investors looking to invest in corporate bonds. Whether it's 1 year, 2 year, 5 year, or 6 year, the 3 years still can be used as a reference index. And if any investor wants to invest in the whole portfolio itself, it is an investable portfolio, and there's enough liquidity in the bonds available. So now I leave it to Jay to take you through the index construction.
Thank you very much, sir, for your insight, full thoughts. I would like to take forward and explain more about the INRBonds Retail High Yield Bond Index. First of all, uh, why an index? As very well explained by Arjun sir, many retail investors are unfamiliar with the benefits of a corporate bond investment. Our index aims to bridge this gaps by providing a starting point for the retail investors to explore the world of high yield retail bonds. An index serves as a crucial starting point for the investors to navigate the vast Indian debt market. Similar to popular equity indexes like Nasdaq and Sensex, our index will act as a performance indicator for the retail bond segment. Encouraging retail bond investors to diversify their risk beyond the traditional investment makes our economy more robust against the financial turmoils. Monitoring index performance offers valuable insights into the market trends and sentiments, providing retail investors with a better understanding of economic conditions. So, how did we make this index? Step 1, issue selection. We focused on issues with coupon rate exceeding 9% while maintaining a credit rating of AA plus to A minus. Then, we utilize metrics such as the number of issuers, the total volume outstanding, and 1 year historical trade data to 1 year historical trade data to sort issuers further. Visualizing the average YTM spread from the GSEC of the issues with the similar maturities was a step 3 for us to see the trends and the changes in the 3 year corporate bond market. Step 4 was filtering the selected issuers based on the 3 year of primary and secondary data. And step 5 was the final building of the portfolio, the index. Here is the index. The 3 year bond index is an investable index which has a face value of 100 and an annual coupon of 9.58%, paid every 15th of January, with a modified duration of 2.5. This particular index consists of issuers Andhra Pradesh State Beverage Corporation, Arca FinCap Limited, 5-Star Business Finance Limited, Hinduja Leyland Finance Limited, Navi FinServe Limited, Credit Access Grameen, IIFL Limited, and UP Power Corporation. Each of these issuers were given equal weightages to their current trading levels to provide a aggregated average portfolio yield of 9.58%. The credit rating of these issuers have remained stable throughout past 3 years, which gives the stability. Again, our index is based on 3 fundamental pillars, that is stability, liquidity, and transparency. The index also has a rating distribution where about 37% of the issuers are rated double A minus and double A, and 13% are rated A plus and A. At the same time, around 75% of the issuers are from the non-banking finance companies or NBFC sector, and 25% of the issuers are state guaranteed, which gives us a good mix of private and state guaranteed bonds. Last but not least, the challenges which we faced. The inconsistent data posed a significant challenge in constructing this index, impacting the accuracy and reliability of the index. Addressing the inconsistent data required a combination of proactive measures, robust processes, and continuous monitoring. Lack of secondary trades. The lack of secondary trades or low liquidity in the corporate bond warrants another significant limitation in construction and maintaining an accurate corporate bond. To fill in this gap, we use the bid-ask prices for the respective issuers with their relative lower liquidity for better price discovery. With every passing month, we would be getting back to the issue to the index to update the yields provided by the issuers and updating them to the given scenario to update the index and keep it up to date with the market sentiment. That's my piece. Thank you very much.
Thank you, Jay. So in the index is about 240 basis points spread over the 3-year GSEC. As I mentioned, it's a 3-year constant maturity index. The NAV at this point, at the point of launch, is rupees 100, and it will, as the yields go up and down, it will obviously keep changing, and investors can be will be releasing the total return of the portfolio on a monthly basis. The index will be rebalanced if required every quarter, just to update the changes in the market sentiments and current and conditions, and and if there is any other bonds that are more sought after by retail investors. And we are seeing a lot of interest at the retail level, given a lot of public debt issues are coming on, and the regulator SEBI has come out with a consultation paper where even private placement, which is now a minimum face value of rupees 1 lakh, can come down to rupees 10,000. All this will benefit the retail bond market, and the INRBonds retail high yield bond index will help you have a very strong reference point in all corporate bonds investments you make. Thank you very much, and do follow the index in all our channels.